Real estate versus stocks. It's one of the biggest debates out there for investors. But what really happens when you actually run the numbers side by side over a 20-year timeline? One person's journey was filled with late night calls and surprise repairs. The other's was pretty much automated. And I think the result after 2 decades is going to surprise you.
All right, so to make this a fair fight, let's meet our two investors, Jake and Marcus. To keep things simple, they are identical in every way that matters. They both have $50,000 in savings, they make the same salary, they live in the same city, and they're the exact same age. You get the picture. The only difference is what they decide to do with that 50 grand.
So Jake, he decides to jump into the real estate game. He takes his $50,000 and uses it as a 20% down payment on a $250,000 rental house. He's using leverage, that's the bank's money, to control a big tangible asset, something he can actually drive by and point to.
Marcus, on the other hand, goes for what seems like the total opposite. He takes his whole $50,000 and puts it into a total stock market index fund. Basically, he's buying a tiny little piece of almost every major company in the US. Then he sets up an automatic $300 a month investment and, well, that's it. He just plans to let it sit.
All right, so here's our roadmap. We're going to follow their initial setup, see how reality bites in the early years, check in at the mid-game where things get surprisingly close, and then, of course, deliver the final 20-year verdict. And stick around, because after that, we'll look beyond the numbers to see who the real winner is.
Okay, let's kick things off with the setup. We have two investors at the exact same starting line, but their paths are about to split in a really big way. This is where their stories truly begin. So right out of the gate, Jake is feeling like an absolute financial genius. He gets a tenant, and they're paying him $1,800 a month. His mortgage, only $1,330. You do the math, that's $470 of what looks like pure profit hitting his bank account every single month. You can see why this feels like a total no-brainer. Okay, now let's hit the fast-forward button a few years and see how things are really going. This is where the story you tell yourself with napkin math meets the one that real life actually writes. After 3 years, if you just look at the rent checks coming in, it looks amazing. That on-paper profit has stacked up to nearly $17,000 in gross cash flow. It really looks like Jake is just crushing it. But, and this is a huge but, then real life happens. You've got property taxes, which are never fun, insurance, and then the stuff that always seems to break at the worst possible time. The water heater dies, a leak springs in the roof. Oh, and his tenant moves out. So now the house is empty for a month, not making a dime, plus he's got to shell out cash to clean it up and list it all over again.
And there it is. That's the gut drop moment. After you subtract all those real-world costs, that nearly 17 grand in profit, it shrivels down to about $3,000. A far, far cry from what he thought he'd be making. And that doesn't even count a single minute of his own time or stress.
So after all that, where do they stand 3 years in? Well, if you look here, Marcus, who's been doing literally nothing but auto investing, has a portfolio worth about $76,000. Jake, on the other hand, has built up around $60,000 in home equity. So Marcus is ahead in liquid net worth, but Jake has that powerful force of leverage building wealth for him behind the scenes. Now let's jump ahead to the 10-year mark. This is where things get really, really interesting. It's like that old story. The tortoise of compounding is about to meet the hare of leverage, and suddenly, the race is incredibly close. Let's be clear about Jake's secret weapon. It's leverage. It's his superpower. Think about it. He put in 50 grand of his own money, but he's controlling a $250,000 asset. So as the property value goes up, he gets all the gains on the full value, not just on his little down payment. That's what really juices his return. Now, Marcus has his own superpower, and it's called compounding. It's way less flashy. It's a quiet, patient force where your investment earnings start generating their own earnings. It's honestly kind of boring for the first few years, but over time, it becomes this unstoppable snowball of wealth. And would you look at this? After a full decade, their net worth is almost identical. Jake's equity in his property is sitting around $177,000 after a decade of work. Marcus's hands-off portfolio? About $172,000. It's a dead heat. All right, let's fast forward one last time, all the way to the 20-year finish line. This is the moment we've been waiting for. The final numbers are in, but like I said, they don't even begin to tell the whole story. After 2 decades, Jake's equity in the property is somewhere between $400,000 and $500,000. And Marcus?
His stock portfolio has compounded all the way up to a value between $420,000 and $460,000. So financially, it's basically a tie, a wash.
But how they got there couldn't be more different. Jake's journey was defined by debt, late-night phone calls, and the stress of managing a physical asset. Marcus's journey was defined by market ups and downs, for sure, but his investment was liquid, diversified, and completely passive. One required active work, the other just active waiting.
So let's step back from Jake and Marcus for a second. What does this all mean? Well, the crucial point is that you have to choose the investment that actually fits your life, not just the one that sounds best in a headline. Look, the case for real estate is powerful. You get that incredible leverage. There are major tax advantages, like depreciation, and you own a tangible, physical asset you can actually control. You can even use creative strategies like house hacking or tax-deferred growth with something called a 1031 exchange.
But the case for stocks is just as compelling. I mean, it offers completely passive growth. It's highly liquid, meaning you can sell it anytime you want. It's effortlessly diversified. It takes up literally 0 hours of your time. And maybe best of all, no tenants, no toilets, no turmoil.
So what's the ultimate takeaway here? Which investment is truly better? Well, that brings us to the real conclusion. It's not about the asset you choose. It's about the analysis you do before you choose it. Because the real trap isn't real estate, and it isn't stocks. The trap is picking a path because you heard a good story, without ever mapping out what it truly costs in dollars, in time, and in stress. A truly informed choice might even be a mix of both, combining the leverage of real estate with the simplicity of stocks. So the next time you think about your own financial future, don't just ask which investment is better. Ask yourself this: have I run my numbers? Have I really accounted for all the costs, both the ones I can see and the ones I can't? Because that is the only question that truly matters.